we got and the cooler than expected CPI print this week. Our next guest says we've seen the Fed's last rate hike, saying the odds that we see a recession from here are getting lower. Joining us here at Post 9 is Fundstrat Global Advisors Managing Partner Tom Lee. You've been very optimistic on the market and on the inflation story and on the economy story. So is your bottom line that the data is all reinforcing your view?
Yes, I think yesterday's CPI report kind of shows that inflation's on a glide path lower. The things that are still inflationary, like auto insurance, motor vehicle repair, aren't things the Fed's necessarily trying to target with higher rates, but it's more of a supply chain work through that. And so I think over the next 3 months, we could see core CPI at 0.2 or less. That would really allow the Fed to breathe easier, and that's why I think the last hike was July. And from an earnings perspective, companies sort of are getting through the worst of those headwinds. And Q2 earnings, ex-energy, was actually up year over year. So I think this earnings cycle is turning, and we have $5.5 trillion of cash on the sideline. So I think once we get through this rough August, I think it's going to look pretty good for the rest of the year.
I mean, the counter argument, Tom, is that the market's already priced in the soft or no landing scenario that you just painted, and that the Fed being done. And now there are questions of whether that's really the right call. Core CPI, for instance, is still 4.7%. We still have indication that things are rising, like wages and energy prices. That sort of calls into the question either the last rate hike or time till the first cut.
Yeah, I think one of the things we have to be careful of is looking at year over year, because it really lags changes. So let's say core over the next 2 months prints the same as it did this, which is 0.16.
0.2.
By the 2 months
you round
from now,
down, I round
yeah,
up.
0.2. In 2 months, core is going to go from over 4 to something with a 3. It's going to drop more than 100 basis points just in 2 months. So what you're doing is you're dropping all these big numbers from last year. And then from a stock perspective, people forget that early in an expansion, multiples typically expand by 7 or 8 times. So we should expect PEs to push towards 22, 23 forward, because we're early cycle, and then as earnings start to catch up.
Margin stabilizing, I guess, it makes you constructive. What is your S&P number for earnings next year?
We think it's going to be around 250, but if the dollar softens, you could be 255, maybe even 260, and then, even at $90 oil, you don't really kill the earnings story in the S&P. I mean, $90 oil is kind of where it was in 2018. It's not like it's an economy killer.
But how much more runway do you think this market has for that view, for the whole soft landing view that the Fed has done and they haven't created a recession? Like, isn't that why the market is up double digits already this year? Yeah,
you're asking a positioning question. I don't think people are even that bullish. I mean, this week, everyone's been very quick to turn bearish. I mean, one just has to look at the comments from a lot of folks, and they're already back in the hard landing camp, or the top is in. Yet, we know investors pulled $115 billion out of the stock market this year, and there's $500 trillion in cash. And mortgage rates could drop pretty dramatically. If the Fed is done and the 10-year stays at 4, mortgages should drop to 5.5%. That'd be hugely stimulative next year. So I think there's a lot of catalysts.
Not to mention unlocking a lot of new supply, people who wouldn't feel as bad listing. So if you had to pick a worry between inflation and growth, I assume it's inflation?
I think the worry could be growth, because the Fed could stay, if they're higher for longer and inflation's dropping, they're actually really constricting the economy. So I think it's going to be important for officials to recognize that they probably need to cut rates earlier than they think.
So you're going to be on the watch for real rates to start to hurt.
Correct.
Growth.
That's right. Because again, in 2 months, core CPI is going to be more than 120 basis points lower year over year. And Fed funds are still 5.5%. So we're talking about rates are going to be dramatically tightening on a real basis the next 2 months.
Although we had a discussion this morning about the amount of debt that's fixed, and isn't that pass-through going to take longer to demonstrate than we think?
Yes, but you'll feel it through things like credit card, revolving debt. There are a lot of people who unfortunately do have short-term debt or LIBOR-based, and 1-year ARMs, and so there's a lot of, you're still on the fringe going to see it.
Are you a buyer specifically of tech on this dip?
Yes, but in the second half of our top 3 sectors in order would be industrials, energy, and then tech FANG. So we still like tech FANG, but there's a lot to like about the industrials and a lot to like about energy.
So tech FANG on lower rates, industrials and energy on soft landing?
Yeah, and cyclical improvement and earnings recovery, yes. And all because of financial conditions eventually easing.
You always manage to maintain the optimism and bullishness, and you've been right this year.
He was cautious about August, I got to say, going into August.
All right.
Tom was
Yeah, I mean,
What happened to that caution? We've done it?
Well, it's been messy. I think the second half of August will be better, but it's been messy, yes.
Yeah, no, it's felt like that. Tracking another down week here. Tom, thank you. Tom Lee from Fundstrat.
Meantime, short-term